Hello friends, welcome to my channel. In this video you will learn about what are sovereign gold bonds, what are gold ETFs, and what is the difference between these two and which is more beneficial for you. Sovereign gold bonds are the government securities that are denominated in grams of gold. So it means if any person want to invest any amount in SGBs, he has to purchase at least 1 gram, okay, because these are denominated in grams of gold. And these are government securities, so there is no risk of default involved. There can be a risk of capital loss, but only in case when market prices of gold decline. But there are rare chances because there is a lock-in period in SGBs of 8 years. Okay, so in such a long time, there are rare chances that gold prices will decline. And gold ETFs are the commodity fund that trade just like stocks. So we can sell it, we can buy it anytime we want, right? In a trading session, we can trade just like stocks. That's why the name suggests is gold exchange traded fund. Okay, so we can trade on exchange. And there is a lock-in period only in case of sovereign gold bonds. There is no lock-in period in gold ETFs. So this is the major benefit in gold ETFs. We can sell it anytime. And there is an investment limit in case of SGBs, minimum 1 gram of gold, because these are denominated in grams of gold, right? So minimum investment we have to purchase at least 1 gram of gold, and maximum 4 kg for individual and HUF and 20 kg for trust. Next is gold ETF. In case of gold ETF, there is a minimum limit of 1 unit. It means 1 gram of gold. Okay, so 1 unit is equal to 1 gram of gold, and maximum there is no limit. We can purchase any number of units of gold ETFs. So now let's discuss the returns of SGBs and ETFs. So first, returns are in two ways in case of SGBs. First is capital appreciation. Whatever the market price increase, we will get in terms of capital appreciation. Second is regular interest income, 2.5% per annum. We will get in half yearly because it will be disbursed half yearly. And in case of ETFs, there is no interest because there is no lock-in period or there is restriction. There is no restriction in case of ETFs, so there is no interest income. Only we get a capital appreciation whenever we sell it. Okay, so we can sell it anytime if we want. So there is no interest income in ETFs. There is interest income in only SGBs. So this is the benefit of SGBs, we can say, because there is an extra interest income we get from SGBs. And next is there is a limited liquidity, as we have discussed. There is a lock-in period and we can redeem it only after 5 years, and there is a maturity period of 8 years if we want all the benefits. Okay, so there is a limited liquidity in case of SGBs, and there is a high liquidity in case of ETFs because we can trade it through exchange. So whenever we want to sell it, we can sell it through exchange. Okay, so this is the benefit of gold ETFs. So next, let's discuss about the tax implications of these incomes. So for SGBs, there are two incomes. First is interest income. So interest income will be taxed as per slab rates. So it means if a person fall in 30% tax slab, then 30% rate will be applicable. So it means interest income we just have to add in taxable income of the taxpayer. Okay, and whatever the slab rate he is in, he will pay tax according to slab rates. And for capital gain, it will be exempt only if held till maturity. If we have redeemed before maturity, then in that case we have to pay long-term capital gain tax. Okay, and in case of gold ETFs, there are two cases: short-term capital gain and long-term capital gain. Why short-term? Because we can redeem it before 36 months, right? So if we redeemed it before 36 months, then we have to pay short-term capital gain tax as per tax slab rate. It means whatever the gain we have, we have to add it to the taxable income of the assessee. Okay, and he will pay as per tax slab rate. And in case of long-term capital gain, it means the holding period of gold ETFs is 36 months or more. Then in that case 20% tax will be applicable, and with indexation benefit. And what is indexation benefit? In case of indexation, we raise the cost of acquisition as per cost inflating index.